Why are you wanting to sell? Now, yes, I sold Tesla recently. You can check that video right up there. And I actually sold some other stocks last year as well to clean out my portfolio. But every single stock that I sold was because of fundamental reasons in my plan, not because the market may crash, okay? Big difference there. Not because I wanted to take profits. Now, if you're trading, then that makes sense. But as a long-term buy and hold investor, taking profits mathematically lowers your long-term gains. That's what all the studies say from Wall Street, from big banks, from big institutions. We even did a back study in our group as well. That's what all of them all say. You are going to lose out to dead people over the long run doing that. So I sold because of fundamental changes to the business that were not for the better. That is exactly why I sold out of all of those stocks. Selling because you think there will be a crash doesn't really seem like the best idea. You are selling out of fear. And guess what, guys? Here's the sad part about selling out of fear. There are 37 predictions a year of a crash coming or a crash is imminent or ever, but we really only get one once every 5 years or so when they do actually happen. So, 37 predictions a year, one every 5 years, that means there's like 140 or so predictions that go wrong and just a handful of them that go right that one time. And guess what? I don't even fear those. I don't understand the fear at all, because when it does happen, when they are right, they are a golden opportunity, not something to be feared. I mean, who wishes you could buy Apple at $2 per share, right? Well, you could during the big crash in 2008 and 2009. Now, that's a split adjusted and everything, but back then, split adjusted, you could have bought Apple for $2 per share. Who wouldn't take that, right? Well, let's get more modern. Some of you guys don't like Apple. Got it. Hey, but what about Palantir at $6? You could get that all day long in 2022 during that crash. I mean, you got more than a year, somewhere in between $6 and $8, $9 or so, to buy that stock over and over and over again during that crash. I don't fear them at all. I absolutely want them because I know that's where fortunes are made. But you could only do that. You could only make that fortune if you knew what you owned, so you had the guts to buy it, and you know what kind of opportunity was being laid at your feet. Now, thankfully, I've done that work. A lot of you guys out there have done that work. So I bought heavy during those times, and so did many of you, and you guys were all richly rewarded for that. And my guess is you also had the next point in place, which is, what is your plan if the market does crash? I have a plan for if the market crashes. Already laid out, not waiting until it happens, already laid out years in advance of a crash actually happen. That is where fortunes are made. So I want a crash and I want to be prepared for it. That's what I want to be, so that way I can take advantage of it. You can't take advantage of it in the moment. You have to be prepared ahead of time. And instead of chasing all the hype last year, right, where everybody's buying these stocks where, hey, they got a PowerPoint, maybe a little bit of revenue, but, to the moon, right? The stock chart goes like this, all of a sudden explodes straight up, everybody's piling in then. Instead, a lot of you guys and myself, we were busy stacking cash and selectively bought. And what I mean by selectively buying is I didn't really buy a lot last year, if I'm being perfectly honest, but my return is well over 100% of those shares bought. And that includes some PayPal, if you can believe that. So I really, really like how that worked out whenever you selectively buy based upon valuation. I already know the companies that have the fundamentals to weather a downturn. So I know what I will be buying. I know what the valuation for each one of those companies is, so that way I don't end up overpaying, because sometimes the stock can drop 50%, and guess what? It's still 50% overvalued. It needs to drop further before it reaches a cheap price, so you got to know that valuation. And then I already have price targets set where I want to add more, and I know exactly how many shares I would buy, and if it dips lower, which it always does because you cannot time the bottom, I will increase the number of shares I buy. It is all planned out in advance because I know I cannot do the next one, which is, can you actually time the market? When folks are actually going to sell out because a crash is coming, they are timing the market, to be quite frank. That's what you're doing. Call it what you want. Call it macro this or all this other craziness. You're trying to time the market. I've never timed anything perfect ever. The greatest investors of all time say that they can't time it and say that they have no clue what the market's going to do in the short term. But yet folks routinely make decisions that are nothing more than market timing. I know, guys, I'm not part of the problem, but I know where I'm at. Right here on social media, that doesn't help at all, because there are a million indicators indicating something every day that works 100% of the time, actually only 2% of the time. Because if it actually worked 100% of the time, everybody would just do that and everybody would be trillionaires, right? That would be the easiest thing to do. So clearly, indicators don't tell you anything 100% of the time. But I know I cannot do it. The greatest ever can't do it. None of the greats can do it. Hedge funds can't do it. Supercomputers can't do it. Supercomputers combined with hedge funds combined with a bunch of Ivy League MBAs can't do it. So I choose to understand what I own instead and plan ahead for what I will do if the market does crash, because if all those folks can't do it, at least in my case, I know I cannot do it. Get your money right. Part of being prepared is to assess your financial situation and get your money right. Start making those cuts before a crash happens. Get your budget and your finances and everything else in line before a crash happens. And if you want to have even more capital to invest, work those extra hours. Start a side hustle to make money to invest, or just simply stack the cash, however you choose to do that. Turn your house into an asset, right? Go to the house hacking route and make it to where instead of you paying a mortgage every month, your tenant is paying your mortgage for you and you're living for free. That frees up a ton of money. You can also get a certification that can advance your career, some other sort of certificate or something else in your field that provides you more and bigger opportunities. Take the big leap and start your own business. Either way, no matter what you choose to do, doing some or all of these will increase your investable cash to take advantage of a downturn, because it does you no good to be prepared, know exactly what stocks you want to buy, know exactly what you want to buy, exactly how many shares, everything else, but then you don't have any cash to actually buy the actual stocks because you didn't take care of the money in the first place. Number 5, to thrive in a crash, just do this. The way to thrive in every single crash, not that you're going to get every single stock perfect, but to come out on the back end of these things, making a fortune and a ton of money and being really, really happy that you bought like you did, you got to do these things. So first up, don't panic, but plan. I can't emphasize that enough. Panicking does you no good. Emotions do you no good. It's going to destroy you. Instead, have a plan and then follow it without emotions. Next up, understand what you own on a high level. It is so easy to buy stocks when you understand what you own. It doesn't matter what the narrative is because I know what the truth is, because I understand what I own. And trust me, whenever stocks were crashing, it was a terrible idea to buy Palantir at $6. It was going bankrupt and they'll never turn a profit. It was a terrible idea to buy Meta because Zuck's lost his mind and therefore this stock is going to be bankrupt and he's going to kill the whole company. In hindsight, they all sound really silly, but at the time, the folks that believed it just simply did not understand what they owned in the first place. Next up, you won't time the bottom, so stop trying and DCA or do a modified DCA instead. Guys, it really is that simple. There is no timing the bottom. It's impossible. To me, the way I kind of view it is, here comes the crash down. All right, I'm going to buy some, here, here's the bottom. I get inevitably never going to time that sucker. And then as it comes back up, you're buying here, and here on its way back up. Or if you're doing a DCA, you just simply DCA all the way down and all the way back up. Simple as that.
Investors feel afraid, they buy protection, insurance. And for thousands of years, that protection has come in the form of gold and silver. These aren't assets that people buy to get rich. They're assets people buy when they're afraid of losing everything. But recently, something strange has happened, because over the past year, as the stock market has surged to record highs, gold and silver have surged alongside it. The assets that were supposed to protect investors from chaos are suddenly behaving like part of the boom itself. And when a risk-off asset starts behaving like a casino, it raises a very important question. Are these assets still hedges at all? With gold and silver prices recently falling as much as 15% and 34% respectively across just a matter of weeks, have they too become just another volatile asset class in an ever-widening bubble? Gold and silver are interesting assets because while they are used as a commodity for things like electronics, a big part of their role in our world is simply to exist as a financial asset. In 2025, just 6.5% of the world's gold demand was taken up by technology, the other 93.5% going towards jewelry, investment, or central bank stores. Silver is slightly different to gold, with around 61% of the 2025 demand going towards either industrial uses or photography, but that still leaves 39% being used in some capacity as a financial asset, whether it be through jewelry, silverware, or investment purposes. So as opposed to copper or nickel or oil, which all have exceptionally high utility, gold and silver act very much more like a store of wealth and protection against the erosion of the dollar. And because of this, their prices tend to fluctuate with economic cycles. When confidence in the financial system is high and investors feel optimistic about the future, gold and silver tend to chill out. Money flows into productive assets like stocks, businesses, real estate. But when that confidence begins to crack, when markets fall, currencies weaken, or the economic outlook becomes less certain, investors begin shifting their money back into insurance, aka gold and silver. We saw this very clearly during the global financial crisis in 2008. As major banks collapsed and the stock market fell by more than 50%, investors rushed to gold. Between late 2008 and 2011, the price of gold rose from around $700 per ounce to over $1,900 per ounce, an increase of nearly 170% while stock markets were still recovering from the damage. The same pattern appeared again in 2020. When COVID triggered one of the fastest stock market crashes in history, investors once again sought safety. Gold surged to new all-time highs as trillions of dollars were printed and uncertainty spread across the global economy. And if you go back even further, the relationship becomes even clearer. During the inflation crisis of the 1970s, as the US dollar rapidly lost purchasing power, gold rose from just $35 per ounce in 1971 to over $800 by 1980. Investors weren't buying gold because the economy was strong, they were buying gold because the dollar was getting eroded. Because fundamentally, gold and silver aren't designed to outperform during periods of optimism, they're treated as a way to preserve wealth during periods of uncertainty. Which is why what's happening today is so unusual. Over the past year, gold and silver prices have surged dramatically, but it's at a time where the stock market is booming. And there are some very real reasons for this. One of the biggest drivers in the case of gold has been central banks. Central banks around the world have been buying gold at the fastest pace in modern history. So not retail investors, not hedge funds, governments. In 2025 alone, central banks added hundreds of tons of gold to their reserves, which continues the trend that began after Russia saw their foreign exchange reserves get frozen in 2022. And because of that, countries like China, India, Russia, Turkey have all steadily been increasing their gold reserves, diversifying away from currencies. Now, at the same time, silver has been experiencing a surge in structural demand. While it might not be the same financial asset as gold, imbalances in the supply-demand equation have caused it too to skyrocket. Silver is predominantly used in solar panels, electric vehicles, semiconductors, and advanced electronics. And as demand for these technologies rises, so too does demand for silver. But supply hasn't kept up. Mining production has remained relatively flat, while geopolitical tensions have made access to key resources less certain. Countries like China have begun restricting exports of strategic materials, prioritizing their own domestic industries over global supply. And don't you know it, they recently did that with silver. So all of these forces help explain why gold and silver have risen. All of it is logical, but it doesn't explain what happened next, because after rising for months, silver and gold didn't stabilize, they both fell hard, a move that is not super common for assets that are supposed to be stable stores of wealth. In the case of silver, it's fallen around 35% in just weeks, wiping out a good chunk of its big rally. An asset that had quietly been climbing based on long-term structural demand suddenly began behaving like something else entirely. And this is where investors really started to question whether these metals are still behaving like stable sources of wealth, or whether these markets have now been overrun with market gamblers. According to Steve Eisman, the reason wasn't fundamentals, it was pure speculation.
On Tuesday and Wednesday, silver rallied, climbing to $88. However, on Thursday, silver declined sharply again, down 16%, and closed at $73.50, thereby giving up almost all its gains for 2026. Too many levered speculators piled into silver at the peak, and when it started to go down, they got margin calls and were forced to liquidate.
Yes, even in silver, the speculators had made big bets and got caught out as the price tanked. And to understand what Steve is talking about here, a margin call happens when you borrow money to invest, but the thing that you're invested in starts falling in value. For example, say someone invests $10,000 of their own money. Now, the broker or bank may allow them to borrow an additional $10,000 to invest using margin lending, giving them a total position of $20,000. So that is a 50% loan to value ratio. But if silver falls by, say, 20%, their $20,000 position drops to 16K. Now, they still owe the broker 10 grand, which means their equity has fallen from 10 to 6,000, aka they've lost 40% of their money from just a 20% downward move in silver. And if silver keeps falling, the broker begins to worry that they could take a loss here too, so they issue a margin call. So the investor is forced to either deposit more money immediately or sell their silver to repay the loan. So in this example, the loan to value ratio has skyrocketed to 62.5%. So to get it back to 50%, they'll be forced to add another $4,000 into their account. But here's the thing, if they can't do that, the broker closes the position, selling the silver. And if thousands of speculators are all using leverage at the same time, these forced liquidations begin to cascade. Prices fall further, which triggers more margin calls, which forces more selling, which causes prices to fall even further. And that's how speculation has turned these metals from long-term stores of wealth into volatile speculative assets. But this is not how insurance is supposed to behave. Insurance is supposed to provide stability during periods of uncertainty. And this is starting to mirror the exact same trend we've been seeing in another non-productive asset, that of course being
never ever sue the driver who crashed into you after a car accident. There's a better way to get compensated that's fast.
Bitcoin. Bitcoin was also originally designed to be like gold, a digital gold. How many times have you heard that from a crypto bro at a party? A fixed supply asset that couldn't be printed, a hedge against inflation, a hedge against currency debasement, a hedge against the financial system itself. That was always the idea of Bitcoin. If governments printed too much money and weakened their currencies, investors could escape into Bitcoin, an asset that governments can't manipulate. It was set to be the new age gold. But in practice, Bitcoin has not behaved like gold, not even in the slightest. The truth is, it's behaved much more like a speculative asset, as we're seeing right now. In fact, since its highs in October last year, Bitcoin has nearly halved. This is what Steve has to say about it.
The people who have been advocating investing in cryptocurrencies have long argued that Bitcoin and other cryptocurrencies are versions of digital gold. In other words, they are hedges against the debasement of fiat currencies or government currencies. Now, gold and silver have acted as such hedges, but crypto has, in my view, completely failed to show that it is a hedge. As gold and silver climbed in January, cryptocurrencies declined, which just leads me to conclude that cryptocurrencies are just a way for investors to speculate about speculating.
I like that phrase, speculate about speculating. And what you've seen is that over the last few years, Bitcoin, instead of moving in line with an asset like gold or silver, has trended much more closely with more speculative areas of the market, like the tech stocks. When liquidity floods the system and tech stocks surge, Bitcoin surges. When liquidity dries up and tech stocks fall, Bitcoin falls. We saw this during the tech sell-off in 2022, where Bitcoin fell more than 50% alongside the decline in growth stocks. And more recently, Bitcoin has once again been decimated, with investors losing 45% plus of their wealth.